Welcome to TFE Talks, Navigating Wealth, Business, and Legacy, the podcast from Thomas Fisher and Edwards. Each episode, our attorneys bring you expert insight on estate planning, business strategy, and legacy building, breaking down complex topics into clear, actionable advice. Whether you're solidifying a strategy we've discussed or preparing for what's next, this podcast is your resource for thoughtful, practical planning. You ready? Let's dive in.
Hello and welcome to another edition of TFE Talks. I'm your host, Jordan Goewey, joined again today by Parker Baker, an attorney here at Thomas Fisher and Edwards in Greenville, South Carolina. Parker, thanks for joining me again.
Yeah, thanks for having me on again, Jordan.
So Parker, we've talked about a couple of business topics in the past on the podcast with you, but like all of our attorneys, you also practice estate planning in addition to business advising. Today, we're going to talk about a topic that really blends the two. We're going to talk about holding S corporation shares in trust and some of the complexity that comes along with that. And so let's just kind of start with the basics of if someone owns an entity or owns shares in a corporation that is taxed as an S corporation, when they come in to do their estate planning, why is it not as simple as just leaving assets in trust as we may do for some of our other clients that have assets that they want to leave in trust?
Sure. Yeah. And I think that's a really good question. I think it's a misconception with the S corporation is that, it's simple, right? It's a small business corporation, but because you get these income tax benefits, because we get the flow through tax treatment, there's some pretty strict rules surrounding the entity and especially surrounding who can own shares in that entity. That can inadvertently terminate the S corporation election. As our business owner clients are likely aware, if you're not an S corporation, you default to becoming a C corporation. And the difference with that C corporation is that double level of tax when the money comes to the corporation and then tax when it's distributed out to the shareholder. If you have an inadvertent termination of an S corporation because you sent it to an uneligible shareholder, you would trigger sort of the fallback to a C corporation. You would trigger double taxation at that point in time. And it can be costly and difficult to be able to fix that.
And so Parker, you kind of started out there with the idea that only individuals in general can own S corporation shares, but there are certain types of trusts that can own S corporation shares. And so what are those three main types of trusts that can own shares in an S corporation?
Sure. So the first is really the simplest. It's a grantor trust. So those trusts, they're treated as owned by you for income tax purposes. And because of that, those trusts can own S corporation shares. So think, your typical revocable trust, certain irrevocable tax planning trusts that we do will structure this way as well. But think the person who created the trust is still alive is generally, I think, how you could think about the grantor trust with respect to the S corporation shares. The next two types are special elections that you make with respect to a trust. You can make them while the person, the creator of the trust is still alive with certain irrevocable trusts, but typically these are elections that would be made after the death of the business owner with respect to the trusts. The first is a qualified subchapter S trust, also known as a QSST or the fun term QST. And then the second is the electing small business trust, the ESBT, or also affectionately known as the ESBT.
Yeah, so a QSST, talk to us some about the requirements for a QST, how the trust has to be designed, and who actually makes a QST election.
Yeah, so the QST is a lot more restrictive than the ESBT. So with the QST election, what happens is you need to have a trust that really just has one beneficiary, and that one beneficiary needs to get all of the income from that S corporation for their lifetime. It can't be a pot trust, so there can't be multiple beneficiaries involved in that trust. Only one person can be a beneficiary of the QST. And the QST is a beneficiary-driven election. The beneficiary is the one who affirmatively makes the election. And with the QST, like I sort of alluded to, the key point is that all of the money comes out. So any S corporation income that comes into the trust has to go out to the beneficiary any income earned by the S corporation is going to be taxed on the beneficiary's personal return. And for that reason, it can be more tax efficient, and we can get into the differences for tax treatment between the ESBT and the QSST. But the downside is that QSST does force all of the income out to the beneficiary. So for that money, you are losing the protection of the trust structure that you otherwise had set up.
And one thing I'll note, Parker, is you noted that the QST election has to be made by a beneficiary. So if a person owns an S corporation and they intend to leave it in trust for their children's benefit, they have to then rely on the fact that their children are going to make the election appropriate, and that they don't accidentally revoke that S election by not making the QST election at the appropriate time. For that reason, I think it's important that as part of the governing documents for the S corporation, as part of the stock restriction agreement, maybe, that there is some sort of requirement put in place that someone will make that election. Otherwise, they're required to maybe sell the shares to the others who are more willing to make the election, so that you don't have that inadvertent termination. I think it's good to put sort of safety measures in on that. The other type of trust that you mentioned earlier is an ESBT or an ESBT, an electing small business trust. And so that one is a bit more flexible. Tell us some about its requirements and how its election is made.
Certainly. So with the ESBT, like you said, it's much more flexible, right? We can have pot trusts. It doesn't just need to be one beneficiary. We don't have to send the money out to that beneficiary, any of the income from the S corporation that comes in. And really the requirement there, pretty much all of the trusts that we draft would qualify. The requirement is that the beneficiary or the beneficiaries themselves would qualify to be S corporation shareholders. So they do need to be individuals, U.S. citizens, U.S. residents, things of that nature.
So, Parker, to your point, ESBT elections are a little bit easier to make because we're relying just on the trustee to make those and not relying on beneficiaries. They also are more flexible in the terms that you can have for an ESBT in general. So with those two big benefits of ESBTs, why would anyone ever want to make a QST election? What's the point in trying to design a trust so that it's eligible to be a QST?
Yeah, so the reason that you might want to make the QST election is that in some cases it can be more tax efficient, right? So, and just to sort of back up a little bit, the way that trust taxation works generally is that either the trust or the beneficiaries pay the tax. And usually the trust gets money and it distributes that money to the beneficiaries. The money that's distributed carries the tax with it. Any money that stays in the trust is taxed at the trust's tax rate. And that trust tax rate is much higher. It hits the top rate somewhere around $15,000. So you can see that the tax may be much higher for money that the trust retains inside of itself. With the QST, all of the income is pushed out and all of the income of the S corporation is taxed on that beneficiary's personal return. So if you have a beneficiary who has a lower marginal tax rate, minors, maybe incompetent individuals as well, who aren't otherwise making a fair bit of income, it can be much more tax efficient to have all of that income show up on their personal return, rather than is the case with the ESBT, where every single dollar of that S corporation income is taxed to the trust. Doesn't matter if it's distributed out. It's all taxed within the trust structure. So it hits that top rate a lot quicker. And so, and not just for federal purposes, because you can say for federal purposes, if you have a beneficiary who otherwise has a very high tax rate, somebody who's themselves already at the marginal tax rate, maybe you're not really getting a benefit with the QSST. Because, even if the trust tax rate is already at, the top marginal rate, well, that beneficiary is too. You can see on the margin some difference with state income taxes. In South Carolina, I'll note that we have a preferential rate for income taxes for businesses that qualify for the active business income tax rate. That's not available for ESBTs. That can be a couple percentage points. The SALT workaround that's likely popular with a lot of business owners, that also is not available for ESBTs. So there can be small percentage points, sort of swings on the highest marginal rate individuals as far as planning for the two of them. But for folks that are, for beneficiaries that themselves would not be at those higher tax rates, it can make more sense to make that QSST election, at least from a tax and income tax perspective.
And so, Parker, this is obviously a very important decision as to, how a trust is going to be structured and what flexibility it's going to have on making these elections. How early in the estate planning process do you like to consider this, and what sort of flexibility can you build into an estate plan for these elections?
Yeah, certainly this is an important decision to plan for on the front end. Where do I think my beneficiaries are going to be with their tax rates? How important to me is the protection of the trust? Right? Presumably, you're setting up the trust because you want to protect that money. And so, in a lot of cases, even if the income tax says we should do the QIST, in a lot of cases, we'll say, well, no, we really do want to retain the money in the trust structure and be able to protect it from creditors and all the other benefits that we have from the trust structure. And so it really should be a part of those initial estate planning conversations. That being said, like you said, it's very important to build in flexibility. We don't have a sense now, obviously, of what will happen in the future. And for that reason, in the documents, we like to have that flexibility to allow the trustee to do anything necessary to qualify the QSST, to qualify the trust for QSST election for the beneficiary to be able to make, to allow the trustee to make the ESBT election, to be able to do the things necessary on the back end to put these elections in place.
And Parker, we talked early on in this conversation about the fact that what we're really trying to do here is avoid an inadvertent termination of the S corporation status, because that can lead to all sorts of tax consequences. Let's say that everything goes wrong. Someone didn't administer a trust properly, or didn't make an election, or the trust wasn't designed properly. Is there any way to fix an inadvertent S termination? Is there anything that can do, or that we can do, if something were to happen?
Yeah, we can. It is not a desirable process to go through, obviously. The IRS will, in certain circumstances, provide relief. You generally need to show them, what we did was inadvertent. We didn't know that we were going to terminate the S election and that we were transferring those shares to someone who was not an eligible shareholder. If you can show that, they do have relief procedures. Again, there are fees associated with obtaining that relief.
And so, Parker, as always, we like to give our clients practical advice. So for clients out there who maybe own shares in an S corporation, or think they may end up owning shares in an S corporation in the future, what practical advice do you have that they can approach right now, related to their planning?
I think you've sort of alluded to it, sprinkled throughout this whole conversation. It's very important to sit down, if you with other people in the business that own it with you, and make sure that you guys have a stock restriction agreement in place. We want to avoid inadvertent terminations, not just at death with these trust elections we've talked about, but with transferring interest during life to other ineligible shareholders. And I think it's also important to merge that business planning, all of the things you've talked about with your stock restriction agreement, to make sure to share that with your estate planner as well, so that they can help you plan for the business in the future as part of your estate plan.
Yeah, and Parker, one additional thing that I would say is that this is a place where we really like to take a team approach. We practice business advising and we practice estate planning, so we can really cover a lot of the thoughts that go into this within our firm. But even still, we love to pull on outside advice as well. Work with the accountant for the business and for the grantor of the trust, and make sure that everything is that make sure that we're all on the same page, that we all make a informed decision about the best way to go about this type of planning. Because certainly, if there was an attorney that you're working with who just does estate planning and doesn't do any business work at all, they may not be thinking about these issues at all. You certainly don't have to practice in both areas like we do, but if you only do estate planning, then you probably need to be pulling on the guidance of that CPA, because that's something that we do, even though we cover both of those areas. And so, Thanks again for joining me today to talk about what's a very complex topic, but one that I think is very important for clients to be aware of. And I look forward to having you on future episodes of the podcast.
Looking forward to it. Thanks again, Jordan.
Thanks for listening to TFE Talks. For more information, please visit our website at www.tfelawfirm.com. You can also follow us on LinkedIn, Facebook, and Instagram by clicking the links below in the show notes. If you have any questions about topics discussed in the episode, or you have recommendations for future topics, please email us at info@tfelawfirm.com. See you next time.